U.S. Federal Reserve says interest rates to rise if inflation rises. It will be the first rate hike since the coronavirus outbreak in March, as the Fed seeks to contain price increases. Announcing that it will keep interest rates around zero for the time being, the Fed indicated that it was planning to hike rates at its next two-day meeting. Announcing that the Fed will continue to watch the economy, inflation and unemployment, Fed Chair Jerome Powell provided the strongest indication yet that the US's record low interest rates would soon begin to climb. To avoid a financial meltdown in the wake of the coronavirus outbreak that reached the United States in March 2020, the central bank lowered interest rates to almost zero and started purchasing financial assets. To put the stimulus program to a close, the Fed committee voted last week to authorize one more round of asset purchases. The Federal Reserve has a twin mandate: to increase employment and stabilize prices. While inflation has spiked to an annual rate of 7%, unemployment has decreased to a pre-pandemic low of 3.9% in recent months. Rates are expected to climb in an effort to rein in price increases, and Powell indicated there was a lot of space to do so without jeopardizing the economy. Investors, on the other hand, have been frightened by the conclusion of the Fed's loose money strategy. Days of wild stock market fluctuations followed, as investors feared that the Fed would terminate its reign of cheap money too quickly and that escalating tensions between Russia and Ukraine would have a negative effect on economies throughout the world. On Monday and Tuesday, US stock markets plunged, only to recover most of their losses the following day. Although the S&P 500 suffered its worst ever losses at the start of a year on Tuesday, the once hot tech sector was responsible for the majority of those losses. Powell's speech to the Federal Reserve Board dragged down the U.S. stock market, which had been gaining gains, on Wednesday.